Hi, I'm Jimmy. In this video, we're going to look at discounted free cash flow, what it is, how we can calculate it, and how we can use it to find value stocks. And we're going to pull it all off in under 4 minutes. Okay, let's kick it off. So now, at the most basic level, here's the concept of discounted free cash flow. The idea is that the value of any business or investment is the present value of all future cash flows. To illustrate this, let's use a bond as an example. Well, a bond will typically have predetermined cash payments. So let's imagine we're going to get $1,000 each year for the next 3 years. And then our terminal value is going to be $20,000. So the very idea of discounted free cash flow is that if we add all of this up, well, what is this $23,000 in future cash flows worth today? Well, that would depend on what our required rate of return would be from a percentage standpoint. We call that the required return. So let me show you how we can apply that. So this is what the discounted free cash flow formula looks like. So we take each time period's cash flow and we divide that by 1 plus R. R is the required rate of return. Now, we're going to use our example. We're going to call our example, our hypothetical number, 10%. So each year would be 1 plus 1.1 raised to the power of 1 for year 1, raised to the power of 2 for year 2, and so on. And then when we do that basic math and clean these up a little bit, well, we can see this is what the new formula would look like. Well, again, if we perform this very basic math, we can see what the present value is for each year. We add all of these up, and we can see here that we get a present value of 17,513. So the idea is that we want to pay less than this present value. Now, the process is nearly the same when we're looking at how to do this for individual stocks. The only real difference would be how we calculate the terminal value, or the future years after our projection. And to come up with that terminal value, well, this is what the formula would use to come up with the terminal value for a stock. And the only new number that's introduced here is the perpetual growth rate. The idea here is that we take our final year free cash flow and we grow it out. Well, what rate are we going to grow it out forever? Ideally, we want that rate to be fairly conservative. Generally, somewhere between 2 and 3% is fairly accepted. So we can see that this math is fairly simple. We just take our final year free cash flow, grow it out, come up with our terminal value, and divide that by the final discount rate that we had used for year 3 in our example, or year 5, or however many years you decide to go out. Now, to see this in action on individual stocks, let's jump over to the Investors Grow website just to see how it could work with some actual examples. Our first example here is Chevron. Now, we're using the same 10% required rate of return that we used in our example before. And our estimates, which you can see here in the green bars, well, those estimates come from analyst estimates. A lot of times it's a good place to start. Instead of having to calculate our own, that generally takes a ton of time and a ton of research. But the idea here is that we take these analyst estimates for free cash flow, then we calculate the terminal value. And if we're curious, we're using a perpetual growth rate of 2.5%. The more conservative between the 2.5% to 3%. And just like that, we get a fair value of about $181 per share. So we can see that Chevron looks about 16% undervalued. Well, now let's jump over and look at a competitor. When we jump over and now we're looking at ConocoPhillips, well, we can see that we actually have 5 years of analyst estimates. And again, this works the same way. Although ConocoPhillips is undervalued, not undervalued quite as much as Chevron is. Now, if you'd like to get access to the Investors Grow website, I will leave a link right here. If you're curious how to come up with these numbers on your own, I actually did a video all about the process for analyzing a company. I will leave a link right here to that as well. Links to both of those in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.